More families end up paying the IHT because they don't realize property that they own and their assets, things like investments and that stuff, passively increases because of inflation, and that tips them over the threshold into having to pay. At the moment, the Office for Budget Responsibility, which has a lot of economic projections, is predicting that by 2029-30, nearly 10% of estates will be subject to the inheritance tax, and it believes that the government's going to earn 14 billion. That means that there is going to be a massive increase in the amount of money the government is earning from inheritance tax in the next few years. Now, there is cause for concern here. Obviously, inheritance tax isn't affecting all estates, but I think with the effects of fiscal drag, the real problem is that the families who don't realise they're going to have to pay it are the ones who end up being tipped into it. Hey everybody, my name's Edmund Greaves. I'm editor of personal finance platform Mouthy Money. I've got a couple of really interesting stories to jump straight into today. First of those is about inheritance tax, and then a little bit later on I'm going to be talking a little bit more about the Bank of England cutting its base rate and whether this means a mortgage rate price war for mortgage holders and customers. Let's not hang about though, let's get straight into it. What's going on with inheritance tax? Well, the UK government has just published its latest figures on the UK inheritance tax take. For the year 22-23, it's taken another record level of tax. It's taken £6.7 billion in inheritance tax from families. So what's driving this? It's driven by rising property prices, debt prices, and the fact that the threshold for inheritance tax and gifts and allowances and that kind of thing hasn't changed in years and years and years. So what's in the details? So according to HMRC, 31,500 estates were liable for inheritance tax in 22-23. That's a 13% increase compared to the previous year. The total amount of tax is actually increased by 12%, up from 6 billion the year before on these figures. So this is all said in mind of the fact that actually the new Chancellor, because these figures are from the old Tory government, the new Chancellor Rachel Reeves made changes to inheritance tax rules recently. They're introducing new limits on tax reliefs on things like business assets, agricultural land, and now also unspent pension funds, which I'm going to come back to a little bit later, is really important. Let's look a little bit deeper though. Why are more people being affected? I think what's really interesting here actually is you look at these numbers every year, and every year they go up, and they go up for one reason, and that's because of fiscal drag. Now, fiscal drag is something that we're a little bit more familiar with, things like in income tax, because we know that those thresholds haven't changed in a number of years. So basically, when you get pay rises, you tip into higher kind of income tax bands. The same thing happens for inheritance tax, though. Inheritance tax is applied at a rate of 40% on estates valued above a tax-free threshold of £325,000 per person. If you're married, you can double that amount. You also get an additional allowance of £175,000, which is an allowance for your main residence. Again, if you're married or in a civil partnership, you can double that. So potentially up to £1 million of estate tax-free. But these allowances haven't changed in a long time. The basic allowance hasn't changed since 2009. So that means every year as inflation goes up, as assets prices increase over time, particularly property, that means more and more families end up tipping over those thresholds and being due to pay inheritance tax. Same with the residence allowance. That's been was introduced in 2017, has been fixed since 2021. So more families end up paying the IHT because they don't realize property that they own and their assets, things like investments and that kind of stuff, passively increases because of inflation and this kind of thing, and that tips them over the threshold into having to pay. At the moment, the Office for Budget Responsibility, which kind of does a lot of economic projections, is predicting that by 2029-30, nearly 10% of estates will be subject to the inheritance tax, and it believes that the government's going to earn 14 billion. That means that there is going to be a massive increase in the amount of money the government is earning from inheritance tax in the next few years. Now, there is cause for concern here. I mean, obviously, inheritance tax isn't affecting all estates, but I think with the effects of fiscal drag, the real problem is that the families who don't realise they're going to have to pay it are the ones who end up being tipped into it. Inheritance tax is often referred to as Britain's most hated tax, and that's because it's seen as a form of double taxation. People are taxed on the income, they're taxed on the spending, they're taxed on savings throughout their lives. And the kind of thanks you get for that is the government takes away a portion of your estate when you die, money that you've kind of were responsible enough not to spend and to spend a lifetime working towards building up. This is going to get worse from 2027 because the government is bringing pensions into our inheritance tax. So that means they'll go into the calculation. A lot of people are going to find themselves suddenly going way above that allowance. And I think those OBR projections are probably going to increase even more. So what can you do? Well, it's really tricky. If you're in a position now where you have an estate, you've built up a lifetime and you've got property and assets and this kind of thing, you need to, understand how much that could all conceivably worth. And I think with inheritance tax, it's such a complicated tax with so many rules and allowances. It's probably really important to get professional financial advice. It's not something to be kind of, messed around with and trifled with. And the potential bills, if you do go over those thresholds, can be really high. So I would seriously recommend thinking about speaking to advice in that instance. You might be younger, you might be my age, you might have parents who are a bit older, maybe they've never talked about it before. You might be worried that they aren't thinking about it and maybe they haven't realized that something could happen. I think it's a very tricky topic to get into. It's very sensitive. People and us Brits, we know we're not good about talking about our money, but you've got to prepare for those kind of eventualities because you have to remember that it's not the parents who pay the inheritance tax. It's you, the children, it's the people who inherit pay the inheritance tax. And that can create so much difficulty when you're trying to deal with bereavement and think that this kind of stuff, it's awful. So, try to speak to your parents, understand the position they're in and whether they're prepared for it. Just opening that dialogue up, having that conversation is so important, I think, just as a starting point to realizing what the potential implications of this could be here. Now, let's move on to mortgage rate wars. So is there a mortgage rate war looming because of the Bank of England? Now, why am I saying this? So the Bank of England is expected to cut the base rate this week because of kind of gathering economic storm clouds. There's a good chance that we'll get a 0.25% base rate cut, and then possibly later in the year, we're going to get another one. So that would bring the base rate from currently 4.25% down to 3.75%. Now, it's not guaranteed that they're going to cut, but because of a couple of factors, namely the economy, GDP is kind of flatlining. The economy's not growing, which it needs to do in order for kind of everybody's lives to get better and this kind of thing. And also we've got the slightly more worrying figure with employment. Employment seems to be falling, and that's a real indicator because employment's quite what's called a lagging indicator. The data that we see from the Office for National Statistics is usually quite late. So there are signs there that the economy is not doing very well. Now, the Bank of England looks at these figures, but its primary target is to keep inflation at 2%. So the problem here is that inflation is nearer 4% at the moment than it is 2%. But they seem to be looking through that more towards what's happening in the economy because of the slowdown and this kind of thing. And some of the inputs into inflation are kind of one-offs. That means that the inflation will steadily come down, even if rates aren't as high as they currently are. Now, this suggests that we, might be able to get cheaper mortgages all of a sudden, but there's a bit of a problem here. So whether or not there's a mortgage rate war depends on a few things. So the mortgage providers, they do set their interest rates on their mortgage products with the base rate in mind. But ultimately, the rate they offer to new and existing customers, it's based on what's called the swap rate market, which fluctuates a lot over time. It also matters, what lenders' requirements are. It might be that they want to bring more mortgage customers onto their books, so they might have slightly lower rates to appear more attractive to new customers. Alternatively, if they don't want more mortgage customers, they'll keep rates higher because that kind of dissuades people from taking mortgages with them in quite as many numbers. So thinking about whether we're in a mortgage rate war now, whether it's coming. So there is some good data on this. Really good provider of data called Money Facts. So as of the 1st of August, it showed that the average rate for a mortgage was 5.04% for a new mortgage. That's down from 5.1% a month before. So not much, a little bit, but it is moving downwards a bit. If we look in a bit more detail, 2-year and 5-year mortgage averages are currently both 5.01%. Again, a little bit lower. The 2-year is down from 5.08 and the 5-year is down from 5.07. So it's kind of inching lower, but it doesn't seem like there's a rate war in progress yet. That being said, lenders make decisions all the time, so it's really important to look at what's going on the market. And the big question is you might be coming up to your remortgage this year or next year. What should you do? So the first thing is, I would say, is just ignore what the Bank of England's doing. They're going to cut their base rate. They're not going to cut the base rate. It doesn't have immediate massive impact on what the mortgage market is doing. And the media spends so much time waffling about what the bank mortgage is being helped by the Bank of England, blah, blah, blah. It's more complicated than that. You need to make your own personal decisions. What you need to do is you need to shop around for a deal and look what's out there in the market. Try looking, 6 months ahead. I'd really recommend speaking to mortgage brokers as well, because they're really good at tapping into what's going on in the market. Make sure that they have a wide range that they're able to look at. Sometimes they're not able to look at the whole market of kind of mortgage products. And what you can do is you can fix 6 months out, you can get a new rate for your remortgage, and that's great. But then what you can do in the meantime is, before really locking that in, is you can keep looking right up till the last minute. And if things do continue to come down, you can kind of get onto a slightly lower deal. And actually that can make a huge difference. We could talk about a lot of money here on a kind of annual basis, and even over a 20-25 year mortgage or something like that, depending on what you've got. Now, one of the biggest concerns I think at the moment is around affordability, because people maybe haven't got pay rises, or the cost of living has gone up since they last got their mortgage. They've got less disposable income. That's a real concern. It's something I worry about all the time in my kind of personal finances. I've got a mortgage. It's actually coming up for renewal in the next 18 months ago, so I'll talk about that at some point. People might be really worried, and they might think, okay, well, I'll just go with my current lender's offer because I don't have to go through all the affordability checks with that. And that's true, and that's fine. And if they offer you a remortgage on that basis and you're happy with that, then that's okay. But generally speaking, those mortgages tend to be a little bit more expensive than the kind of the best deals on the market. So you're exchanging that assurance that you don't have to go through the whole process again with slightly higher costs. So it's important to speak to a broker. They will be able to look at your affordability. Remember when you first took that mortgage out, those numbers that they went through with you about your spending and how much credit card debt and all these things and how much you earn and everything. And they will help you find a mortgage that they think you'll be most likely to be accepted for. So again, shop around, make sure you're looking for the right kind of deal. There are options available. And if you feel like you're in difficulty with your mortgage, make sure you speak to your lender and think carefully about what to do. I'm super interested to hear from you. If you do have a remortgage coming up, what's your plan? We always say here at Mouthy Money, make sure you have a plan that goes for all aspects of your finances, from short term to long term, and that really matters. That you don't bury your head in your sand. Have a plan, make a plan, short, medium, long term. That's really key. That's it. That's all we've got for today. Thank you for tuning in. Please do give us a like and subscribe. It really helps the channel. You can find more information in the description below. And just to finish off, this video is produced for general information purposes only. It should not be construed as investment, legal, tax, mortgage, or other forms of advice. If you're in any doubt about the themes expressed in this recording, consider consulting with a regulated financial professional for your own personal situation. Past performance is no guarantee of future results. Investments can go down as well as up. You may get back less than you started with. Investments are speculative inherently and can be affected by volatility. Never invest more than you can afford to lose. For more information, visit www.fca.org.uk/investmart. Thank you very much, and goodbye.